Hey, good morning, everybody. Welcome to the first day of the second half of 2019. It's hard to believe that this year is halfway over. Um, it's been something else. I tell you, the markets have been crazy, and when we continue to see that today. Hey, I do want to remind you about our free report we're still offering about retirement planning. You know, the retirement strategies that you need to have in place for your retirement. If you are 5 to 10 years out from retirement, or if you've already retired, these are important strategies that you need to know and understand. And to get your free copy, text the word retirement to 863-285-3815. You can also click the link in this video presentation on Facebook, and it'll take you right to it. Again, thanks. Dave will be with us in just a few moments.
Wind and fire. We're at 8:37 here. 23 here before 9. Time check in and find out how Wall Street's playing with your money this morning. How does that IRA and 401k look? Well, God's honest truthful, not half bad this morning. Let's go downtown Sebring and check into the offices of Statler Financial Services, where Phillip Statler is standing by. And Phillip, one small step for man, one giant leap for the markets. All President Trump had to do was step across the North Korean border, shake hands with the fruitcake over there, and say, I think we're done fighting with China for a little while, and the market is back to happy days are here again, right?
It sure does seem that way, Dave. I'm telling you, buddy. It was a great day on Friday. Everything was green pretty much across the board, and we were getting gangbusters today. We talked last week about how a lot of stuff hinged on China and the U.S. and Trump and Zeiss, however you say his name, is their meeting. And so evidently that meeting on the surface looked well enough for the markets have taken off gangbusters this morning. But when you get into the weeds a little bit, the question is, does it really and truly make a difference? Is it going to come to fruition?
And that's the thing, to catch folks up that really didn't get the nuts and bolts of the thing. Basically, the president of China and our president basically agreed to a cooling off period, declared a truce. Our president said, oh, well, Huawei, the big Chinese cell phone maker, we're going to be a little nicer to them, and we're going to start talking nice to each other. Then he made a quick stop over and shook hands with the fruitcake in North Korea and stepped across the border for the first time and got a lot of good press off of that. But as you say, it's just a truce and a pause in the negotiations, and it doesn't necessarily mean we've settled all our differences, right?
Oh, that's right. And so let's look at the other part of that, and that's, it puts a whole new complexion on the game of these markets, right? So now, Trump did some good things from a PR standpoint over the weekend. The first president to ever cross over and stand in North Korea. I mean, it's just some good stuff happened. But how's that really going to translate to the marketplace? We're seeing a huge bump this morning. But the other thing that I read an article that really made sense to me is that, we were betting on the Fed lowering interest rates in July. And that was predicated on the markets having a rough time and inflation having a rough time. Well, with this today, the market's going gangbusters. It may alleviate the problem for the Fed having to reduce interest rates, which means they would keep the status quo this year.
And, I hadn't thought about that until you mentioned it when we first got on the phone earlier this morning. That's right. If this just temporary truce with China on the trade war actually does give the boost to the economy, the markets seem to be indicating it could. The Federal Reserve would be smart to say, let's hold off. We need more quivers in our bow and arrow when the actual recession does hit. We really don't need to reduce interest rates now. And boy, is the market going to be happy if that decision happens, right?
Well, I'm not sure how that's going to work out, because it's kind of baked into our numbers now. And now we've added on top of this this China truce. It's not a reduction. We're not taking anything off the table. We're just not going to put anything else on the table. And we were, like you said, we relaxed the whole deal with Huawei. So, but it's not a totally, hey, we're opening our borders back to them. You have some access now. So it's not 100% back to where we were.
Yeah, we got kind of double run-up baked into the market right now between the expectation of an interest rate drop and optimism over the China thing. If we start having rough patches in the trade negotiations with China and the Federal Reserve says, I think we'll wait, boy, that's an awful lot of baked-in sweetness that we're going to have to take out in a hurry.
Well, it's that, and we're now heading into earnings season, right? It'll be I don't know, next week probably before we start to see much come out. But as we head into earnings season, if we have very much in the way of disappointments, that may take the luster off of this market.
And given the guidance we were getting on the last earnings season statements, expectations aren't for a really heavy-duty gangbusters earnings season this time around. So, yeah, there may be some disappointments. This really doesn't sound like the silver lining that I was expecting.
Well, the other part of what you just said, though, is that expectations have been diminished. So I'm expecting the analysts to be lowering their expectations too when they start giving us the numbers of what they expect earnings and revenue to be. And so those things may end up line in line, but when we start comparing them to the prior year, that's what's going to be, I think, incremental in seeing what companies are actually doing.
And that may very well be the metric that they're watching the closest. There's one metric that seems to always override all the other ones every earnings season. And year over year, given the fact that we saw a lot of chinks in those armors in the last earnings season, that might very well be the dominant number that analysts will be watching now in the upcoming season.
Yeah, that's true. Hey, let's switch gears a little bit. You and I've talked about this extensively the last few months, actually, and that's our economic expansion and how economic expansion eventually has to go into contraction. Well, it's official. As of today, we have now set the longest economic expansion in U.S. history, going 121 months. The last one that we had that was this long was March of 1999 to March of 2001, which was a 10-year expansion. So let's think back to what happened in that expansion and what happened in that contraction. That was a 3-year deal. Starting in 2000, we started the dot-com bubble busted. And so we started to see a heavy decline from 2000 to 2003. They went back to say, the last one was probably 2008 was the last contraction. So if you look at the last two contractions we've had, they've not been just, hey, let's just ride this through. They've been drastic reductions in the market, Dave.
Especially if someone was heavy into tech stocks at the time of that crash. And you can write off as being, it was just a tech bubble. And yeah, it was kind of dumb. We were buying companies with sock puppets losing billions of dollars. But NASDAQ dragged the other indexes down by a bit too during that period.
Well, and that's true. And so if we look back at the last two kind of contractions, it's been two different things, right? In 2001, it was the dot-com bubble. 2007, 2008, it was a subprime mortgage bubble that busted. So I'm looking to try to figure out, okay, what bubble do we have now? And I think we may have a couple. We have student loans definitely is an issue. They tell me, and some of the stuff I've read is that auto financing is becoming somewhat of could be somewhat of a bubble.
That was one thing that one of my friends that watches that junk had suggested to me, that we watch auto finance defaults, because that he's expecting to be the next big bubble.
So we have some bubbles that could bust. And I don't want people to think that, hey, we're being really pessimistic here, Dave, but I think people need to be prepared. And unfortunately, when I sit down with folks, I don't see people preparing for the worst. They just think the best is going to always be there. And we know from history that's not going to happen. And so people need to be prepared for what happens when this market does bust. Are you going to be affected? How are you going to be affected? And how much risk do you really have in your portfolio? And at this point, is it too much given we're hitting all-time highs?
Now, well, there's that, and you bring the point up very well, and something that you and I have been talking about now for months and months now. The thing that trips the next bear market and trips the next recession is completely and utterly unpredictable. As you say, the tech bubble one time, a subprime mortgage bubble the next time. Might be car loans, might be student loans this time. We don't know. But the bottom line is the economy's big and the economy's resilient and the economy does recover. But what causes these hiccups is really something we don't know until it actually happens.
Well, that's true. And so if folks are 5 to 10 years out from retirement, let's look. In '08, it took, like you were telling me before we went on the air, it took till about 2015 for people to get back to even. Folks, that's 7 years. And so if you're 5 years out from retirement, it's vitally important that you are looking at your risk profile and making sure that you've made adjustments to your portfolio. Unfortunately, the industry that we're in, the investment industry, the standard is to buy and hold. Keep it, hey, everything's going fine, just stay in the market, don't get out. Folks, I'm telling you today, you need to be prepared for that next step, especially if you're 5 to 10 years out from retirement or you are already retired. I don't think I can stress that enough, Dave.
Bingo. Yeah, buy and hold might be really wise advice for the 40-year-old who's looking at 25 years before retirement, because continuing to put money in while the market is down, that's like free growth when it recovers because the market is resilient. But the 60-year-old looking at that, it's a completely different set of rules.
You're so right. It really is, and unfortunately, in the world we live at, nobody makes that adjustment. When I sit down with folks, I don't see anybody that makes that adjustment. They keep doing what they were doing while they were working, and so as we head into retirement, it takes a different mindset, a different philosophy to get you through retirement. And it's not the buy and hold strategy that's going to work for you. It's making sure that you've got the right diversification between what do you have at risk in the market and what do you have safe where your principal will not decline in a market downturn.
Understood. So bring us back to where we're at. We'll set the table for the week ahead. Friday was a darn good day. Not a gangbusters day, but an optimistic day. Dow was up by about 0.25%, up 73 points. NASDAQ was up by a little under 0.5%, up 38. And the Standard & Poor's was up by about 0.5 point, up about 18 points. Not a bad day, but not something you're going to break out champagne over. Then the weekend happens, and we have the events with President Trump and the Chinese president declaring a truce, dropping by and having coffee with North Korea's premier, and stepping across that border for the photo op. And, oh boy, the only thing that's going to hold us back this week is going to be the unemployment count on Friday, I guess. Where are we going 45 minutes before the opening?
Hey, we've got gangbusters this morning, Dave. I mean, everything's 1% or higher. In the marketplace. We got the Dow up at 1%, $273. We got the S&P 500 up about 1.2%, $34.55. We got the NASDAQ. Man, the NASDAQ's up 1.8% this morning. That's 141 points. Huge increases across the board there. Now, we do have gold and silver retreating. Gold significantly down 1.2%, back down below 1,400 an ounce at $1,396 an ounce. Silver's down about 0.2%, still above 15 at $15.31 an ounce. We've got the ugly one today, which is crude oil is up 2.8% this morning, Dave, at $60.11.
I'd never like to see that number. But we can't forget the Middle East is still a boiler pot, isn't it?
It is, and there's some talk about some cuts coming still from the Saudis.
Understood. Federal bond yields, by the way, are up about 3 basis points as well. So there is a little bit of a movement toward equities, and worldwide, it's a pretty similar picture. About the only market in Asia or in Europe that isn't up this morning is the Hong Kong market. And that's because they've got their own domestic issues and an argument with mainland China over how to handle the justice system. Phillip, somebody wants some advice as how to do that stabilizing force on one's retirement, appropriate for one's position and one's age. How do I get a hold of you on the phone?
David, give us a call at 382-0037 to schedule their free, no obligation risk analysis X-ray report. Then we also have our report on retirement strategies. Is vitally important. All you have to do to get it is text the word retirement to 863-285-3815. On Facebook, you can click the link right above this video, And then join us every weekend for the Statler Financial Radio Show, noon on Saturdays, 10 a.m. on Sunday mornings.
On News Talk 730, or we stream it as well at newstalk730am.com. Phillip, thank you so very much. I will catch you on tomorrow, and let's hope we can keep this green ink flowing, shall we?
Hey, good thing, Dave. I'm looking forward to it. It's a short week, but we'll get through it with not much, but we'll make something out of it.
Sounds like a plan. Thank you much. It's 105.7 Light FM and Statler Financial Services, Phillip Statler.
Stop it.
Hey, again, I want to thank you for joining us today. I appreciate you tuning in. And hey, if you like what we're doing here, please share this post with your friends and family on Facebook. We'd love to build up a little bit more of a following, and so you can help us do that. If you like what we're doing, again, share our video with other folks out there. Don't forget to get your free report on retirement strategies. Text the word retirement to 863-285-3815, or click the link above this video to grab the free report there. Thanks again. Have a great day. I look forward to speaking to you tomorrow.